And I think most of the people have heard my introductory spiel a few times, so and they're really not missing a whole lot. We've got a few people here. So I will very briefly go over the housekeeping and then introduce Michael Oosterhof, right? Correct? Did I get that right?
Oosterhof.
Oosterhof. Oh,
Yeah.
see, I'm Oosterhof. My apologies.
That's
We actually
okay.
did kind of practice and I still messed up. So welcome to our third in the series of 4. And we will do the usual Q&A at the end if possible. If there's something really burning, throw it in the chat. And if Michael wants to answer as he goes, I'll leave that up to him. We usually have some time at the end for sure. This is recorded and will be available following probably tomorrow or the next day, and I'll send the link out. And that is all I really have to say for housekeeping. I will let Michael get going, I guess. So welcome and thank you and Dart Bryant for doing this presentation.
Awesome. Yeah, looking forward to it. So my name is Michael, as was mentioned, and we're with an accounting firm called Dart Bryant. We do lots of small business and lots of farm tax work. So happy to talk to you today about conservation easements, and then how that can help with some estate and succession planning opportunities with your farm. So this is just a standard disclaimer, and the main point of it is every plan is unique, so make sure you get good tax advice specific to your plan and your situation. So the basics of a conservation easement, or even donating land to a land trust. The conservation easement gets a donation receipt. So to get that charitable donation receipt from your capital property, the conservation easement must be granted to a qualified organization. And so these organizations are all registered with the government as a land trust, such as Legacy Land Trust is. And the donation value, so the number on your donation receipt, will equal the value of the easement. And that's calculated by taking the fair market value of your land before the easement goes on it, and then calculating the difference between that and the fair market value of your land once there's an easement on it. So you still own the land in the case of an easement, but you get a donation receipt for the reduction in the value of your land that easement has created, as if you've disposed of that kind of portion of the land or those rights of the land. And this charitable donation is treated like a regular donation on your tax return. There are special exceptions for if it's under the eco gift program. So there's just a regular conservation easement, but then if your land qualifies as ecologically sensitive land, you'll hear me mention that a couple times, eco gift or an ecological gift, there's a separate set of rules, but both are treated as a donation in your tax return, with 2 kind of separate sets of rules. So general donation rules, you can claim eligible amounts of gifts up to 75% of your net income. So this would apply to the conservation easement, but not an eco gift. So donations of capital property will result in an additional 25% of the taxable capital gain resulting from the donation being added to this limit. It's really just a long way of saying when you've donated capital property and that's what your donation is, the 75% limit actually gets to be a little bit higher, as a portion of that gain that you're going to have from disposing of that property gets added to your donation limit. And then any donations you can't use up in 1 year for a conservation easement get to carry forward 5 years. And if it's an ecological gift, it gets to carry forward 10 years. And there's a couple other special rules with eco gifts that we will get to. So zeroing in on the conservation easements, the non-ecological gift conservation easement. So when you grant a conservation easement on your property, there is a disposition of a portion of that property. And basically what that means is you now have to report as having sold a portion of your land as a result of doing so. So this needs to be reported in your tax return in the year of the disposition. So again, we calculated this. This was your fair market value of your land before it had an easement on it, minus the fair market value of your land after it has an easement on it, and the difference between these two is your capital gain. And then 50% of that difference is what is called a taxable capital gain. So when you have a capital gain from anything in your tax return, only half of the amount of that capital gain is taxable, and that is the same with a conservation easement. And again, if it qualifies as an ecological gift, another special feature of that program is that you don't have to recognize a capital gain if that land is owned personally. And same as if the land is owned in a corporation. However, if that land is owned in a corporation and it qualifies for the ecological gift program, it also adds to your capital dividend account of your corporation. And what that means is that you also get to pay the amount of that gain that you're not paying tax on in the corporation. You get to pay that amount out to yourself tax-free from your corporation to the shareholders of the corporation. So in the case of the conservation easement, the amount of the capital gain is calculated, mentioned this already, is calculated as the difference between the proceeds of disposition and the adjusted cost base. So the proceeds of disposition, that's what we've mentioned, is the fair market value before and after. And then the adjusted cost base of the property is whatever you paid for the land. Now, you're not selling 100, if you're not doing just a straight up gift of land and you're just doing a conservation easement on your land, you've maybe paid $100,000 for the section that the easement is going on, but you're not disposing of the entire section. So then your cost of disposition isn't the full $100,000 that you paid for the land. Rather, it's a pro rata share of your cost that is proportionate to the amount, the pro rata amount of the fair market value that your land has gone down. And we'll work through a couple numbers in a couple slides here, so it'll hopefully start to make at least a little bit of sense. And yeah, and as we said, the proceeds, when we're calculating that gain, so the cost is a pro rata share of the fair market value, and the proceeds will be that reduction in fair market value. And just a note here in the last bullet, so when you do that conservation easement, your proceeds of disposition will be the total of whatever you get on that donation receipt, plus if there's any cash that you get from the land trust on the transaction, that will also add to your proceeds, obviously. So it's the combination then, in some cases, between cash and a donation receipt. So let's work through some of the mechanics. So these are the assumptions we're going to make. So the land value before the conservation easement is $900,000, and the land value after the conservation easement is $500,000. So that's now the new fair market value of the land after the conservation easement has been put on. Your net income in this case prior to the conservation easement each year is $100,000 a year, and tax on that net income prior to the conservation easement will be $24,000 a year. We're also going to assume that this land has been held for numerous years and has a very minimal cost base. So it won't have much in the way of cost to allocate, just to make our math simpler. So the first amount to look at is the amount of the charitable donation, or the amount of the total proceeds if there's cash and donation involved. So it's the value of the land, 900,000. That's before the conservation easement. Pardon me. And then take off 500,000. That's the value of the land after the conservation easement. So the donation amount, the proceeds would be 900,000 minus 500,000 for a net of 400,000. And to calculate the capital gain, so this is proceeds of disposition, which is in this case, just the donation amount, no cash involved in this example, $400,000. Adjusted cost base, 0. So we have a capital gain of $400,000 and tax on that capital gain. So the taxable capital gain is half of that at $200,000, and tax on that capital gain would be roughly $86,000. So before this capital gain, we had regular income of $100,000. We added a taxable capital gain of $200,000. So our total net income for tax purposes is now $300,000. Now with this regular donation receipt from the conservation easement, we're limited to 75% of our net income. So that's $225,000 plus 25% of the taxable capital gain. So that's that $200,000 times 25%. So our total donation limit works out to $275,000 in this case, in the year of the easement being put on. So we had that proceeds, that value of the easement was $400,000. So now that's coming in as the value of our donation receipt. So we had additional tax though to pay of $86,000. So if we want the donation receipt from the easement to eliminate the tax from the capital gain from the easement, how much of the donation will that use? So we know kind of what's our net donation after we take care of the tax on the conservation easement. So it will take $170,000 worth of that $400,000 donation receipt to take care of the tax on the capital gain portion, which then gives us a remaining donation credit of $230,000 to use to eliminate tax this year and in the 5 years to come on our regular annual income. So what is a donation receipt worth? So the value of a donation credit in Alberta ranges from 29% to 50%. And the reason for the range is because we have a higher donation credit in Alberta than we pay in tax. So what happens is first you run out of Alberta tax, but then you still need to use up some donations if you want to keep eliminating your federal tax. And so this means depending on how much donation you use in each year, the savings will range. So in this case, 29 to 50% value of a credit on $230,000 is $66,700 to $115,000 worth of tax savings that you would be able to realize over those 5 years. So the main point here is, so this will carry forward 5 years. So you'll be able to use this to eliminate tax on your income for the current year and the following 5 years. But good planning is required so that you can make sure you're getting the maximum value out of that donation. We don't want to claim donations at just the 29% credit if we could save it and claim it next year and get the 50% credit. But we don't want to save it just to get the 50% credit if we're going to run out of time anyways, meaning if we have more donation receipt than we have taxable income to eliminate tax on, we just need to use as much as we can every year, and we'll get closer to the 29% savings, somewhere in between there and 50%. So when you get to the stage of having a plan in place, make sure you get some good tax advice to make sure that you're utilizing that donation credit as good as you can. So now I'm going to zero in on the differences. I've kind of alluded to it before, just because I think it's important. If the conservation easement qualifies for the ecological gifts program, there's a few benefits to that. first benefit is there's no capital gain on the disposition of the interest in your land. So in our example, we just used, I'll flip back quick, we just used $170,000 of our $400,000 donation. So over 25% of our donation got eaten up, eliminating the tax on that capital gain. So with no capital gain under the Eco Gift program, we would have that extra $170,000 of donation amount to use to eliminate other sources of income. Also, the donation carry forward period is extended from the next 5 years to the next 10 years. And the benefit of that, obviously, is we can try and use more of that donation receipt at that 50% credit level rather than, just having to get it used up in 5 years and using more at the lower 29% level. And then one more point that I should have put on this past slide is the other note is that on an eco gift, you are not subject to the 75% of net income limitation. You can claim as much as that eco gift in 1 year as you want or as is required to eliminate the taxes you want to eliminate. So it just gives more flexibility in your planning. So if we rework our prior example numbers for an eco gift rather than just a regular conservation easement, still a $400,000 donation. So the calculation of the proceeds of disposition of the donation amount is the same calculation. But once we get there, we just don't have to we don't have to have any capital gain that is taxable as a result, which means instead of $230,000 remaining of the donation, we get the full $400,000, which means our value of that receipt has now gone up from $67,000 to $115,000 being the range, to $116,000 to $200,000 being the range of the value of that $400,000 donation. And again, 10 years gives us a lot more flexibility with an amount of time to use up this donation. So I'm going to take a step forward from the donation receipt to a few succession planning opportunities. So in the case of that taxable capital gain for the conservation easements, there's an opportunity here to use your lifetime capital gains exemption for the non-ecological gifts. And this is the farmland or the qualified farm property capital gains exemption. So each Canadian taxpayer is entitled to a lifetime capital gains exemption on the sale of qualified farm property. And the amount of that exemption is each individual can have a tax exemption on qualified gains up to $1 million. So if you've got multiple people owning the land, each person has a $1 million capital gain exemption if your property is qualified farm property. And so I'll just go really high level on what that means. So the abbreviated definition of qualified farm property is real property owned by the taxpayer, which was used in the course of carrying on the business of farming in Canada. So that's our base definition. So if the farmland was acquired after June 18th, 1987, so there was a change in legislation and they grandfathered in the old rules. So these are the new rules. There's a two-part test to determine if the property is qualified farm property. It needs to have been owned for at least 24 months prior to the sale by a qualified person, being that Canadian taxpayer. And in any 2 years of ownership, a family member must have had gross revenue from the farm higher than all other sources of income. So for 2 years, farming had to be the primary thing happening on this property, or the owner was actively engaged in farming on a continuous basis for at least 24 months. So a family member or the owner involved in continuous farming So a family member having higher income from farming than all other sources, or the owner themselves just continuously farming for 24 months. So two other factors in the capital gains exemption is it has to be used principally in the year of disposition, or in at least, sorry, this is the lifetime capital gains exemption if it was acquired before June 18th, 1987. So just two simpler rules here. So if it's used principally for farming in the year of disposition, it will qualify, or in at least 5 years during ownership. So the benefit here, and there's some tax rules that you need specific advice on specific to your property, but if this land was inherited from a parent or a grandparent and they owned it before 1987 and they farmed it for 5 years during ownership, there's a few mechanisms by which it will still qualify as eligible farm property for the lifetime capital gains exemption in your hands because your parent or grandparent has farmed it for has farmed it for 5 years in the past. So the point of going over the capital gains exemption really is when you have that conservation easement and you're thinking, okay, I might not have an ecological gift, I have just a conservation easement, you might be able to exempt yourself from the tax if that works best for your overall tax picture. If you need to use more of that donation receipt, you can use your lifetime capital gains exemption on that disposition and start to eliminate some more of that tax. So another way to start to eliminate tax and to start thinking about succession planning is you can transfer farm property to your children. And there's a few provisions in the Income Tax Act that make transferring specifically farm property to children has a few good tax options to help smooth that out and do some good succession planning. So the provision for transferring your farmland to your children is that you can elect under the Income Tax Act to transfer farm property to your children at cost. So what that means is if you paid $1 for your land and it's worth $1 million, you can transfer that land to your children at a cost of $1, no tax for you. And when they sell it, they will just have a cost of $1 and pay tax in the future, but that can allow more of the farming assets to stay in the use of active farming rather than being paid in taxes before the land is actually sold. So there's also a few key requirements to use your land to be able to transfer it to your children at this cost amount. And it's a little more restrictive than the lifetime capital gains exemption. And that's probably the main thing to remember is just because your land qualifies for the lifetime capital gains exemption does not mean that it qualifies for the intergenerational rollover. So property has to be used principally, i.e. more than 50% of its life in farming business. So instead of just 5 years under the one set of rules or just 2 years under the other set of rules, if it was owned for 20 years, 10 or more years had to be used in farming. And in that farming business, a qualifying person, being the owner of the land, the owner's spouse, child, common law partner, need to be the ones doing the farming and involved in some form or another. Some people can use a good joint venture agreement to try and do this, but just know that it can't just be anyone doing the farming. You can't just rent out the land and have it count for this. And that qualifying person was actively engaged on a regular and continuous basis. So someone still needs to be involved. And here's just a few considerations. The main one being you have to count the number of years that you qualify for it being used principally in farming versus the number of years that you don't. And only when there was more years that it was used principally for farming than not will it qualify for that intergenerational rollover. So I just want to kind of take a high level overview of why this stuff matters. So when we do intergenerational succession planning with farmers, often, there's a couple different sections of land. Cost bases are often low because maybe the land's already been received from parents or grandparents that is now being passed on to heirs, children, whoever that next generation is. And there's always a lot of tax questions to deal with. The benefit of the conservation easement is to say, okay, so maybe, in our example, we said you're earning $100,000 a year. Well, maybe you're only earning $40,000 a year, in which case a $400,000 donation receipt is, you're going to get some benefit out of it, but you're not paying very much tax at $45,000 a year. So if you have a piece of farm property that is worth, one piece of property that's worth $1 million and another piece of property that's worth $500,000, you can start using up some of this donation receipt by transferring your farmland to your kids. So to the extent you have donations, you can transfer that farm property at fair market value. You can, and then you can use the donation receipt to use up some of the tax on that transfer to your heirs. And so you won't pay tax, and your heirs will get the land at $1 million or $500,000 instead of just the dollar that was paid for it way back when it was originally bought. So they can have an increased tax base so that if they ever sell it in the future, they will pay less tax in the future on that eventual sale. So we're using up all of the good tax mechanisms we can throughout the life of this property. And so the donation receipt on the conservation easement or on an ecological gift is a piece we like to use in that intergenerational planning, because sometimes there's a plan where to accomplish what we want, we need to generate some tax, and that donation receipt can be used to then offset that tax. So for us, this donation receipt really helps us in getting a good tax result on intergenerational planning. So just a few cautions. So the lifetime capital gains exemption can be very complex, and there are some unintended consequences. Just to name a few, when you have a large disposition in 1 year, that's taxable income to you, even if you're claiming a tax exemption against it, which means your old age security gets clawed back. So it's just like an extra amount of tax that you'll pay if you're over 65 and collecting old age security. And then also, if you're claiming your lifetime capital gains exemption, sometimes even though it's tax-free, you do have to pay what's called alternative minimum tax. So you're going to pay an amount in the year you dispose of the property, and then that comes back to you as a tax credit in future years. But it's another piece to keep in mind when you're doing this careful tax planning. It's not as clear shot of just claiming the capital gains exemption and not having any tax. You have to make sure that the way your income is being taken over the period of the years to come will make sure you utilize all the tax credits you're generating as a result. Yeah, just to reiterate, the rules of capital gains exemption, intergenerational rollovers, easements, ecological gifts, they can all be very complex, and there are many factors to consider. And your situation is different from other people's situation. Your goals are a little different than others. So be sure to discuss all aspects of this with your accountant and tax advisor who knows your situation, so that you can utilize these things in a way that best accomplishes what you want to accomplish. And just to end with a little bit of Calvin and Hobbes, I will just leave that there and take any questions that anyone might have. Carrie, are there any questions that have come up? I'm just looking and I do not see any in my chat window, but I'm not sure if there's some somewhere else.
Oh, here's one that's just come up. Can a tax credit go to your estate?
Yes. So when you have a tax credit you haven't used up, when you pass away, you have a final tax return in which you can use up all your unused donation credits. When you have, because in your estate you'll have a deemed disposition of all your property, and you can use any unused, if they're within the time limitation, you can use any unused donations in that tax year. So yes.
Okay, I have another one. If land was purchased prior to 1987 by a parent, transferred to son dies, transfers to his wife, does it still qualify as you described?
I'm going to say I think so, but it would require some close reading. So make sure you ask your accountant about that one. But yeah, it's that it can qualify because of that prior parent farming actively, but would definitely want to just double check all the circumstances there just to make sure.
Okay, here's another one. What if you have more credit than you can use within the 5 or 10 year time frame?
In that case, those credits just expire. So what we do sometimes, what we've suggested to people, now this requires some family planning, which might complicate things, but if children are on board with the easement and with all of that, if their name can be added on title, or if part of the land that has an easement can be transferred to them at cost first and they have higher incomes, then both parents and children get a donation receipt from the conservation easement if you're ready to pass that land on to your children. And if they have a higher income, they can use up some of that donation credit as well. Other things, other ways we look at, are there any capital gains on any investments you have that can be triggered to create income that could use up those capital gains, which will reduce your future tax or the tax eventually in your estate. So we often try to plan and strategize to say, how many different ways can we try and use up this donation receipt? But if you don't use it, it just expires. So at the end of the subsequent 5 or 10 year period, the donation that is unused just falls off the table.
All right. Having these gifts in a will complicates time and other issues. Vesting can be an issue. What do you recommend to smooth this out?
Ooh, lots of good discussions with your ultimate beneficiaries. So lots of talking about it with your kids or grandkids, whoever is going to be the ultimate beneficiaries. Because if everyone is of one mind before it gets to a will, then a lot of this planning can be done before it comes to an estate. So that's usually our recommendation. And yeah, just lots of it requires careful planning, lots of input from your tax advisors, legal advisors, your land trust advisors. And yeah, lots of conversations with those beneficiaries and family members who are going to be impacted by it.
Okay, the next one says, what is the usual legal costs for this relation of an easement?
Legal costs, I don't know.
Yeah, is that what you're asking, Bob? You can unmute if you want.
Basically, what would be the accounting costs for creating such an easement?
So as far as accounting costs for creating an easement, I think all the legwork on the easement is done by the land trust. There might be some lawyers' fees involved with the caveats put on the property. And accounting fees depends. We just give advice to people, so it depends if you're, already we're doing personal tax returns and all of that kind of stuff. So it can be from, $500 to $1,000 for some advice in some meetings to, $3,000 to $5,000 or more if we're doing a full estate plan and all of that kind of stuff. So it depends what level of accounting advice you're getting. If it's just, okay, how can, give me 5 ways I can use this donation receipt, or, are you to the stage where you want to do the rollover of property to the next generation and all of that. So there's a full range of advice we give people when we get to these sorts of easements. But as far as putting the easement on in the first place, I believe that is lawyers' fees, whatever those might be, plus paperwork and a lot of discussions with like legacy land.
Thanks. What are the pros and cons of having a conservation easement come into effect on the death of the landowner?
I would have to look at that one more closely. Off the top of my head, I don't have a good answer for that.
And Kim, you might be able to add to that. I'm not sure. And then the next comment is from Kim. Establishing eco-gift in an estate also presents challenges. Often they're easy to do. It's easier to do easements in life. And Kim, do you want to add to that?
Yeah, I was just going off of Fred's earlier question about having these gifts in a will complicates, pardon me, time and other issues. It is, especially doing an easement, donating land in an estate is more straightforward, but the easements are challenging both for the time in dealing with the estate itself, but also for the land trust, and in particular around eco-gift, because we have no guarantees. So if the person who planned the gift of the easement in their estate was counting on eco-gift, if eco-gift doesn't agree or whatever, and eco-gift will only give kind of the support to a conservation easement gift for a limited period of time. So if somebody does their estate in their 70s and dies in their 90s and things have changed on the land, eco-gift program may change, and they're counting on that from a tax perspective, it could have fairly significant implications. Plus on the land trust side, we've got to do all the fundraising and establishing a stewardship fund and all those things. If we have communication with the landowner in advance about a gift in an estate, we can start to establish those things, but it is more complicated as Fred has identified. There's just more questions, and then you're dealing with someone who's not there to meet their requirements. So easements are much easier in life.
If I can add to that here, just hang on here. I've seen cases where in the will it says the executive is supposed to take the best effort to get the eco gifts and things like that. And you got to ask yourself who's doing the best effort, because the beneficiaries don't want to see things like that. So there's a whole mirror of challenges when it comes to that.
Yeah, I agree. I mean, a gift, like a gift of the land, is easier, right? Because it's a whole package. You're not dealing with interests and devaluing things. It's way more straightforward. Again, we always, every land trust I know in North America says, if you want to gift anything, land, easement, please let us know in advance. Right.
And I guess you just got to talk to your clients, because if you don't qualify as a farmer, if you get the eco gift, you're just as well off. Yeah. So.
Yeah, there's some really good benefits with that. So yeah, lots of conversation, and I really take Michael's point, and I know you agree, Fred, too, that lots of discussion and planning.
Okay, I think there's another one here. I realize this is for easements, but are the tax ratios and percentages similar if it's a straight land donation?
Yes. Yeah. If it's a straight land donation, the ratios would stay the same. The main difference is, instead of prorating your cost, it would just be the full cost of your land versus the full cost of the donation receipt. And then that would be your capital gain.
You've mentioned a few times, Michael, about when the land gets passed on to the kids and the benefit of that. Mm-hmm. If somebody isn't passing it on to another generation, it's going to get sold at some point in time. do you look at easements or eco gifts differently? Or is it kind of the same thinking process?
Same thinking process, at least for us, other than the tax piece, which obviously has some benefits, but yeah, same thinking for us. But yeah, if there's an eventual sale, yeah, maybe there's some consideration to how saleable it is with one versus the other. But in theory, that's reflected too in the fair market value adjustment. So
Thanks.
Okay, another one, just give me a second. Knowing that all land is different, about how long does it take to complete a conservation easement?
that'd be a question for Kim.
Mary Jane can answer that one too.
Oh, awesome.
She's been in training now for a while. Go ahead.
You're gonna put me on the spot. It really varies. It depends on several things. Funding, number one, and when we can access funding. The granting program that we draw most of our funds from has application periods in September, and we don't find out usually until March which projects we get, and so that can really delay things when we're using that body of funds. And then timing, different things take different times. Like for example, we have to do baseline studies, and obviously they need summer months to do those. So it can take anywhere from a year after we have funding to 3 years. And it really just depends on other little things that come up with the projects, but they always take longer than what people think they're going to. You want to add to that, Kim?
Nope, perfect.
Just give me a sec to have a look here. Is there a calculation to determine fair market value after an easement has been registered?
Do you want me to do that one?
Sure.
Okay. No. In a way there is. It basically, once a conservation easement has been registered, if you wanted to know what the fair market value was of it, you would get an appraisal just like you would prior to a conservation easement being registered. In general, what is seen is that if the devaluation or the discount on the conservation easement was, say, 30% at the time of the gift, as property around it without easements increases, so does the one with the conservation easement in about that same discount level. Having said that, there are properties with easements that have sold with less of a discount than what the original appraisal showed, and really that's just a factor of what people are willing to pay, and if the easement maybe allowed certain things that a pool of buyers is interested in. So maybe you can still build a house, or you can still ranch it, or you can, there's still retained rights that are appealing to a pool of buyers, and so the price differential will change over time based on sort of land competition around it as well.
Does Legacy ever work with a landowner who would be willing to cover part of the costs to establish the conservation easement?
Yes, that's an excellent question. We actually currently have a conservation easement project with a landowner who's completely self-funding. It was a project that doesn't fit the Land Trust Grant Program, and we were going to look to other funding pools, which is challenging because a lot of funders don't necessarily look at conservation easements. And so this landowner decided that they wanted the easement enough that they're funding the whole cost. So they've made a donation, and then that goes towards the project on our part. So yeah, we have all kinds of funding models, and and corporations, foundations, and individual donations are what covers the cost of all of these. And so, yeah.
Those are some great questions. Keep firing away if there's any more. You don't have to use the chat if you're more comfortable just unmuting and asking your question. I know that with stuff like taxes, sometimes it's easier to just verbally ask than to try and write it out. Okay. Sorry, I just have one more here. If Legacy received an outright donation of land, what would they do with it?
Well, similar to conservation easements, when landowners come forward to donate land, we ask them to present their vision. So what is it that what is their wish for the land over time? And then we would create management plans and manage it accordingly. With experience I've had with another land trust, a landowner donated land that did not have ecological value, but it worked better for their tax circumstances to donate land instead of selling the land and donating cash. I don't know why. It wasn't eco gift, so I'm not sure why that was more beneficial to them, but it was. So in that case, the land was sold. But if somebody donates it and has that pre-conversation that this is their expectation of what would happen with it, then that's what Legacy would do with it. I think Ed was going to say something.
Okay, yeah, I was going to say somebody was going to say something and I cut them off.
I don't mind being cut off. I work with Mike and I'm listening to the questions about an easement going in through the way of a will. And I cannot imagine anything worse for planning around from the accounting side. If you're thinking of doing this, do not, I mean, I just can't, just the fact that this thing might take 3 years before we get an eco gift in place, very bad timing. Do it ahead of time. You can't plan your tax. You can't plan the usage of your donation credit. You can't sell your land to your kids at higher, not use your qualifying farm property rollover rules. Just do it ahead of time if you want to do it. To all of you who might want to put it in your will,
We agree.
That's all I wanted to say, really.
Yeah, and I think we didn't have this question with the lawyer last week, but I'm certain the lawyer would agree also. Very challenging, probate, everything, like easements and wills. Please don't. I mean, we'll work with you, but please don't.
Here's another one. How would Legacy fund the monitoring and stewardship of an outright land donation?
We would do it the same way we do with a conservation easement. We would have to raise a stewardship fund in order to take care of the land. We use something called a stewardship calculator. We have a stewardship calculator. We haven't had any land donated to us to date, but we have a stewardship calculator that we would put in property taxes, fencing requirements, basic management based on the property itself, and then create an endowment fund to be able to pay for that over time.
Well, it looks like it's pretty quiet. If everybody wants 10 minutes extra in their day, if you don't have any questions, we're more than happy to wrap up. And thank you, Michael. Appreciate you taking the time to do this for us and leading some good questions coming out of it. So I will call it an end. If anybody has questions after the fact, just email, let us know. And we have one more next week. So anybody with questions that you have for the landowner, we would be more than happy to have you send them to us as soon as possible so we can give Terry a few seconds to actually think about them before he gets asked next Wednesday. So that would be appreciated if you have any things top of mind. So thank you all, and happy St. Patrick's Day to everyone. I think it actually is an event today. So that's all. Is that okay, everybody? Nothing else coming up? Great. Thank
Yep,
you.
that looks good. And thank you, Michael.
My pleasure. Thanks for having me.
Enjoy, Michael.
Thanks, everybody.
Thanks. Have a great day, everyone.